Understanding the corporate income tax return. How to understanding the corporate income tax return in Canada. Taxation of companies and the individuals who own them is handled differently than it is under the standards that apply to other types of businesses. According to the legislation, a corporation is considered as an independent legal entity, and as such, it is required to pay taxes that are based on the net income that it has earned. The amount of profit that remains after all business expenses have been subtracted and before any dividends are issued to the corporation's investors is referred to as the income of the company. Understanding the corporate income tax return in Canada and Edmonton, Alberta. A corporation is required to submit its own individual income tax return within the prescribed time frame of 6 months after the conclusion of its accounting period, even if there is no tax liability associated with the corporation. This requirement is conditional on the level of revenue that the company achieves during the specified time period. With the exception of Alberta and Quebec, all of the provinces and territories in the country depend on the federal government to collect taxes on corporate revenue. Both the federal government and each individual province have their own versions of the corporate income tax. The general rate of taxation levied by the federal government is 15% of taxable income. When compared to the rate of corporate income tax paid by other types of corporations, the rate that is paid by small Canadian-controlled private corporations, CCPCs, that are eligible to claim the small business deduction is lower. Income generated during the year by an active business that was carried on in Canada, net of certain income and in excess of specified losses. The rates for the small business deduction, SBD, are as follows. This rate applies to the entire taxable income. For CCPCs with taxable capital between $10 million and $15 million, the small business ceiling of $500,000 in taxable income is reduced at the rate of $1 for $10 of capital over $10 million. Due to the fact that they do not satisfy the requirements, CCPCs with taxable incomes that are greater than $15 million are not qualified to take advantage of the small business deduction. Consult a tax attorney or an accountant if you are interested in determining whether or not your company is eligible to be classified as a Canadian-controlled private corporation, CCPC. If you are interested in learning whether or not your company is eligible, it is recommended that you seek the advice of a tax attorney or an accountant today. What are the corporation tax rates on a provincial or territorial basis? In general, provinces and territories have two distinct income tax rates, one rate, which applies to the income that is qualified for the federal small business deduction, and another rate, which applies to all other types of income. The lower rate applies to the income that is qualified for the federal small business deduction. The higher rate applies to all other types of income. The business limit for each province is determined by the federal government, with the exception of Saskatchewan, which places a limitation of $600,000 on the amount that eligible businesses can receive from the SBD. Further information regarding the tax rates that are applicable to corporations. The governments of Quebec and Alberta have not been able to come to an understanding with the Canada Revenue Agency concerning the manner in which they will collect taxes from corporations. Visit the Revenue Quebec website if you want more information about the tax rates that apply to corporations in Quebec. The tax implications of receiving dividends or receiving a salary from a corporation. If you are a salaried employee, you may be able to decrease your direct tax liability by contributing to an RRSP and deducting those payments from your taxable income. If you have dividend income, the RRSP deduction that is normally available to you will not be able to help you reduce the amount of income that is subject to taxation. On the other hand, because of the dividend tax credit, the percentage of your dividend income that is subject to taxation is lower than the percentage that would apply if you were being paid a salary. The rate of tax that is levied on companies is what will decide how big of an effect the payment of dividends has on the individual taxes of a person who owns shares in a corporation. One of the differences that can be made between dividends and salaries is that a corporation is able to deduct salaries as an expense before it has to pay taxes, whereas dividends are paid out of income that has already been taxed. In addition to that, it is possible that a company will be required to collect and hand over payments for additional taxes. Because corporations are able to choose a fiscal period other than the calendar year, they have greater leeway than sole proprietorships and partnerships do when it comes to computing and paying taxes. Visit the website of the Canada Revenue Agency for more general information regarding taxes. However, if you require assistance in preparing and paying your corporate taxes, BOMCAS Canada Accounting and Tax Preparation Services would be delighted to hear from you.